What's up, everybody? This is Sunko, the Korean Bro. Today is 2022, November 20th. Let's look at economic calendar first, okay? Hmm. Okay, on November 23rd, we have initial jobless claims, core durable goods orders, building permits, new home sales, crude oil inventories, FOMC meeting minutes. And on 24th, United States Thanksgiving Day. Okay. On November 25th, Thanksgiving Day, early close. Okay. So Wednesday is a day I have to look at events the most. Okay. Let's go to mollyfo.com first, okay? Is Lucid biting off more than it can chew? Home Depot is down 25% from its high time to buy. Four fantastic dividend stocks to buy with yields of 4% or more. Former Domino's Pizza CEO joins forces with restaurant brand. Is the stock set to skyrocket? Hmm. Okay, is Lucid biting off more than it can chew? Cheaper Lucid Air models should stoke sales. The addition of an SUV as production increases should give the brand positive momentum. But the company has to overcome supply chain issues to ramp up production. Okay. Cheaper Lucid Air models and a forthcoming SUV should stoke interest among consumers. Cheaper Lucid Air models and a forthcoming SUV. Even as the novice automaker fights to overcome supply chain and financial problems. Okay, they have a new product coming and they fight to overcome supply chain and financial problems. Okay, Lucid announced two new lower cost versions of its first EV, the Lucid Air Dream, with 1,111 horsepower and up to 520 miles of range. The new trim levels, the 87,400 Air Pure and 107,400 Air Touring, were lower price tags but deliver lower levels of performance as well. They offer 410 and 425 miles of range, respectively, which is not shabby, all things considered. They joined the 154,500 Air Grand Touring with 516 miles of range, and the forthcoming 249,000 Air Sapphire. By bringing the starting price of Lucid Air below six figures while keeping performance at the top of its class, Lucid makes its product far more attainable for most luxury car buyers. Mhm. Second model line, but concerns linger. Okay, what's the outlook here? Lucid is a long way from profitability, so they don't have profit yet. They still have a long way to go. It's no surprise given the company's balance sheet, which it declined by $750 million in the past quarter, that along with a forthcoming dilution in stock and diminishing reservations and the concerning and enough to cause someone to sell, certainly it gives non-shareholders little reason to buy. But for those already invested, the start of the forthcoming SUV should provide the company a shot at growing production and sales, although that's more than a year away. So current investors with a longer time frame should watch reservation and production numbers. Given that the stock is down 72% in a year, Now is not the time to sell, given the chance of appreciation, albeit a long-term one. And Lucid's novelty should give them a selling advantage over older, more established rivals. But with legacy automakers entering the space with luxury electric SUVs of their own, it's not the time to buy Lucid stock either. Okay. Hmm. Let's look at TSMC price level. Hmm. They just added let's see, added 60 million shares of Taiwan Semiconductor to the Berkshire portfolio. Well, it's a good sign because the fact that a big company like Berkshire Hathaway added money into TSMC is the reason why an investor like myself have to invest because it's a signal that this stock will go up soon. Anyway, it was a TSMC. Current price level is 82. Okay. Hmm. The dividend cut in half from the 2019 peak and weakening demand for chips. Was this a bad move? Motley Fool contributors Jason Hall and Jeff Santora break down why Taiwan is semi looks really compelling at recent prices. Okay. Hmm. Let's read this one carefully. One is really interesting. Okay. First, Alphabet. The first surefire stock you regret not buying as your knowledge plummets Alphabet, the parent of streaming platform YouTube. So Alphabet is like the parent of YouTube, okay? An internet search engine Google, even with ad revenue taking a hit like the likelihood of a US recession grows, Alphabet's competitive advantage stand out like a beacon for opportunistic investors. The key for Alphabet has long been its utter dominance in internet search. Based on data provided by Global Stats, Google has accounted for 91 to 93% of worldwide search for more than 2 years. This virtual monopoly leads to substantial ad pricing power and a mountain of operating cash flow that the company can use to reinvest in other high growth initiatives. One of these initiatives is YouTube, easily one of the best acquisitions in history. Google acquired YouTube in 2006 for $1.65 billion. YouTube is the second most visited social media platform on the planet, with Alphabet looking at ways to further monetize YouTube Shorts. Uh, the ad revenue needle for YouTube should point significantly higher over the long term. There's also Google Cloud, which is the world's third leading cloud infrastructure service provider. Cloud spending is still arguably in its early stages. And Alphabet should be able to sustain a close to 40% annual growth rate as businesses shift data online and into the cloud. Historically speaking, Alphabet has never been cheaper. Hmm. Historically, Alphabet has never been cheaper, okay? Mm. Let's look at Buck. A second remarkable growth stock that's bagging to be bought during the Nasdaq bear market decline is dog-focused products and services company Bark. Despite Bark continuing to lose money, the company's innovation coupled with industry advantages should allow this small cap stock to shine. The first factor working in Bark's favor is that US pet expenditures are practically recession proof. Okay, it's a you know as a pet owner they have no choice but to buy pet products. So so they go to pet store and buy pet products and pet products made from the company named Bark. Mm. And it's a recession proof because regardless of what's going on in the world, pet owner has to buy products anyway. So it's recession proof. Like we eat every day. We eat three times, three meals a day. You know, they're just the same. Um, okay. It's been more than a quarter of a century since year-over-year spending on pets declined in the United States. Whether it's pet food, veterinary care, or other services such as pet insurance, owners are willing to open up their wallets a bit wider each year to ensure the health and happiness of their furry, guild, and feathered or scaled family members. Bar's not so subtle secret that should allow it to outperform most pet retail stocks is that its operating model is primarily driven by direct to consumer sales. Okay, the reason they can outperform most pet retail stocks is that its operating model is primarily driven by direct to consumer sales. Direct to consumer sales. Although retail order timing can fluctuate a bit, uh, traditional commerce sales that occur in brick and mortar stores usually make up only 10% to 15% of total revenue. Okay. So most of their income comes from subscription service. 10 or 15% is the only percentage offline store. Mm. So traditional commerce makes up only 10 to 15% of total revenue. Okay. Mm. Mm. That means the bulk of sales are coming from lower overhead subscription services designed to generate predictable cash flow and gross margin of around 60%. Because Most of the profit comes from subscription service. They can guess um, their margin, right? On the innovation front, BART has held plenty of add-on sales success since introducing BART Bright for Canadian dental needs, and I should see similar success from the ramp-up of BART Eats, which tailors dry food diets for select drug beads. Hmm. These add-on sale opportunities can really bolster gross margin. Add-on sales success. They've had many add-on sales success, so. Hmm. Okay, anyway, let's read about Okta next. The third jaw-dropping growth stock you regret not scooping up during the Nostra bear market deep is cybersecurity stock Okta. Although Okta's integration of Auth0 has hit a few near-term speed bumps and led to larger quarterly losses, the future is increasingly bright for this identity verification provider. So by using the product made by Okta, you can verify its user. Uh, this company is good at identifying customer and identifying user. So basically, cybersecurity company. Similar to Bart, Okta is leaning on macro trends that are very much to its benefit. Just because Wall Street or the U.S. economy hits a rough patch, it doesn't mean robots or hackers take time off from trying to access or still sensitive information. As time passes and businesses move their data into the cloud, the the onus of protecting this information is increasingly falling to third parties like Okta. Okay, just like what we talked about, Bark, it's a recession-proof company because just because we have a macroeconomic level of macroeconomic um, recession these days, it doesn't mean that a company that provides cloud service um, can be attacked by hacker, right? Mm. So it does mean that those companies can possibly be attacked. So for those companies, they have to use a cybersecurity service, right? And like as more data goes to cloud, the more need they help, the more need they the more they need help with cybersecurity, right? So here it is. As time passes and businesses move their data into the cloud, the ownership of protecting this information is increasingly falling to third parties like Okta. So Okta is like specialized in this area, so they have to they got a lot of demand for it, right? As I've alluded previously, Okta's cloud native identity verification security platform is a big advantage. Cloud native identity verification security platform The more people will use a cloud service, the more data goes to cloud, and the more help they might need with cybersecurity, verification security, right? So Octus relies on artificial intelligence all of the solution to grow more efficient at identifying and responding to potential threats over time. Since cybersecurity has evolved into a basic necessity service, double-digit sales growth should be the expectation for many years to come. Uh, because uh, because they are using high-tech service, which is in this case artificial intelligence. By using artificial intelligence, they are trying to find mm, threat uh, efficiently. Hmm. And this growth is expected to come because the demand will grow for sure, right? Eventually, Okta will benefit from the Auth0 buyout as well. In spite of a higher near-term integration cost, Auth0 provides a means for Okta to enter the European market. So they haven't gone into European market, so they got more room to grow, right? International expansion is a necessary step that should help Okta sustain a double-digit growth rate. Okay. Mhm. C Limited. Let's look at price level of C Limited. Mhm. Okay, let's look at C Limited. The fifth jaw-dropping growth stock you'll end up buying a hand over fist during the national bear market. DB is Singapore-based conglomerate C Limited. How many employees do they have? Let's look at profile of this company. 67,300. Okay. Singapore-based company. Hmm. Global consumer internet company. Okay. Better delights to consumers and small businesses with technology. Okay. Mm, mm. Online games development publishing. Garena is leading online games developer and publisher with a global footprint across more than 130 markets. Okay. Provides global users access to popular and engaging mobile and PC online games that it develops, curates, and localizes. It champions games as a social and entertainment platforms on which its communities can engage and interact. Okay. Free Fire, a popular mobile battle royale game. Free Fire was the most downloaded mobile game globally in 2019. So they also make a game. Okay. Hmm. Leading sports organization, it hosts sports events around the world that range from grassroots local tournaments to some of the most viewed professional esports competitions globally. Okay, so they host global events too, gaming events. Okay, the annual esports awards, Free Fire was named the esports mobile game of the year in both 2020 and 2021. So esports leading company. Okay. Mm, shop online anytime, anywhere. Leading e-commerce platform in Southeast Asia and Taiwan. Consumer and easy, secure, fast, enjoyable online shopping experience. Okay. Connect buyers and sellers within one community defined by the three key attributes: simple, happy, and together. Okay. Monthly active users, total time in app. Hmm. SeaMoney is a leading digital payments and financial service provider in Southeast Asia. SeaMoney's mission is to better the lives of individuals and businesses in our region with financial services through technology. Okay. Mobile wallet services, payment processing, credit, and retail related digital financial services and products. Uh, I feel like I have to focus on Garena, digital entertainment segment that's powered by the hit mobile game Free Fire. What is Free Fire? Let's look at Free Fire first. Free Fire. Hmm. Hmm. Okay, let's game. Okay, wait. Fire. Even though quarterly active users retraced in the June ended quarter to 619.3 million from 725. In the year ago period, the most important thing to note is that 9.1% of these were paying to play. This is considerably higher than the pay to play ratio for the mobile game industry as a whole. Sea's relatively nascent digital financial services segment is growing by leaps and bounds. Okay. Quarterly active users jumped 53%. As of that end of June 2022, we see operating in a number of underbanked emerging market regions, providing access to digital wallets could be a sustainable high growth opportunity. So they have more rooms to grow because they can tap emerging market regions, and when they were talking about Garena, even though monthly active users decreased, they got a high percentage of people who pays for playing this game. Um, and this percentage is considerably larger than higher than the pay to play ratio for the mobile game industry. So, and let's look at third reason. There's e-commerce segment Shopee. Although online retail sales aren't known for supporting seizable margins, Shopee has been sees eye-popping growth segment. Okay, based on the company's second quarter results, it's pacing $76 billion in annual run rate gross merchandise value, traversing its platform. In all of 2018, C recognized just $10 billion in GMV. With growing adoption in Brazil and Southeastern Asia, Shopee could be seized tickets to a considerably higher valuation. So they got three segments: gaming, Shopee, uh e-commerce segment Shopee, and there's the financial service segment. They got so many services. Uh Price level of C Limited is relatively low, but I'll have to think about investing. Its revenue is growing consistently. It's it hasn't earned that it hasn't earned the profit yet. Um, I feel like I have to have second thoughts on investing into this one. Okay, let's look at Tesla. Okay. Still driving higher. Investors considering buying shares now need to think there are catalysts to drive Tesla shares higher from here. For example, Tesla will begin pulling in revenue from its semi truck beginning on December 1st. Semi truck. Okay, semi truck. When it makes its first delivery. The Cybertruck is also scheduled to begin production next year. Cybertruck next year. In addition to EVs, Tesla's energy business continues to grow revenue from its energy generation and store segment. Energy generation and store segment. Okay. That represented 5% of total revenue, and the company says demand there continues to outpace supply. With the business continuing to fire on all cylinders, massive market demand for its products, and the stock price that has been cut in half, it looks like a good time to buy Tesla stock. Yeah, Tesla is a good time to buy stock. Yes, it is a good time to buy the stock. Yeah. Its revenue is growing exponentially, and although because of a macro economic recession, its price level is gone down. It's most likely cut in, not cut in half, but is it? It's cut in half, so it's a good time to buy the stock. Okay, let's read about TSMC again. Taiwan Semiconductor Manufacturing is the world's largest foundry with an expanding global footprint. It is dominant player by far and is only seeing demand for its chip increases. Warren Buffett has likely seen its potential, which is why he's made it a top 10 holding. Okay. The pure play semiconductor foundry has a massive tailwind at its back. Famous investor Warren Buffett created quite a stir the other day when his company Berkshire Hathaway revealed a new 60 million shares stake in Taiwan Semiconductor Manufacturing worth $4.8 billion. Okay. So much, it's now one of its top 10 holdings. Okay. As the world's largest semiconductor foundry, Taiwan Semiconductor manufactures integrated circuits based on designs provided by its clients. Manufactures integrated circuits based on design provided by clients. So clients like Intel, was it Intel? Yeah, Intel, Nvidia, Advanced Micro Devices. They ask TSMC to design products, and they design it. Mm. They design integrated circuits. Based on design provided by clients, including the likes of Advanced Micro Devices, Broadcom, Intel, Nvidia. Yet the industry has been marred in problems born out of the COVID-19 pandemic, and shortages have been rife throughout the supply chain. They've had the multiple issues with supply chain. Yep. Taiwan Semiconductor has also suffered as a result of the geopolitical tensions surrounding China In Taiwan, its stock had lost some of 40% of its value before the company reported better than expected third quarter earnings. So they've had a lot of issues. First, macroeconomic recession, and second, they had because of geopolitical tension between China and Taiwan, and third, they had a supply chain issues, mm, with in line with COVID-19 pandemic. Mm. Over the past month, in combat with Warren Buffett's buy, the semiconductor stock has since climbed 27%. Okay. Though its shares are still down 37% since the beginning of the year, with a market capitalization of over $350 billion, Taiwan Semiconductor needs to roughly triple from its current valuation to achieve trillion-dollar status. As noted, Taiwan Semiconductor counts some of the largest chip companies as customers because so many are US-based tech stocks. Last year, it began construction of a $12 billion 5 nanometer chip fabrication plant in northern Arizona that should become operational in the first quarter of 2024. They have a lot of US tech based company as a client. So they even constructed companies. They even constructed factories in northern part of northern Arizona, and that should become operational in 2024. Hmm. It's no coincidence that Apple recently announced it will begin buying more of the chips it needs for its consumer electronics from a plant in Arizona that will become operational in 2024. So their growth is expected to grow because year starting from 2024, they will begin more chips, and they will provide the chips to companies in the states, right? Taiwan Semi already manufactures its A and M series processors, which are used in its iPhones and Mac computers. Mm. In fact, demand from customers is reportedly so strong that Taiwan Semiconductor says it will begin constructing a second plant in Arizona. So they plan to build one plant in Arizona, and they know that its demand is so strong that they have a plan to build second one in Arizona. And it's also building a foundry in Japan. It already generates over half of all global foundry revenue and over 84% of the sub 10 nanometer chip market. Upfront and pulling away. For as much as Buffett really disliked technology stocks early on, he has grown increasingly comfortable investing in the space. Apple is his largest holding by far. It could be that he sees Taiwan Semiconductor in the same way, the dominant player in its field that few can touch. Yeah, because it's since it has like technical barrier, not so many competitors can you know uh, can can easily tap onto. So hmm. So they're like dominant player, and that consumers absolutely rely upon. That's apparent in Taiwan Semiconductor's third quarter earnings report, which showed revenue jumped 36% to $220.2 billion, while profit surged 80%. While much of the rest of the world was constrained by shortages, the semiconductor leader previously said it had not been impacted much by the sector's downturn because long-term demand was firmly in place. Trends such as rollout of 5G networks, The advantage and importance of data centers for housing company information and increased growth among consumer electronics and auto kept its factories humming along. Rollout of 5G networks, importance of data centers for housing company information, increased growth among consumer electronics, and auto kept its factories humming along. While it has struck a more cautious outlook today than it did after releasing its second quarter report, trimming its expected capital expenditures for 2022 from $40 billion to $36 billion due to equipment delays, the long-term outlook for the cheap stock remains bright. $1 trillion baby, okay. So they they also have competitor, but like uh their competitor have only like 13% share of the market, whereas TSMC got most of the shares. Mm. The semiconductor industry is definitely a cyclical one. So Taiwan semiconductor manufacturing will certainly have ups and downs in the years come. Yeah, born China's invasion of Taiwan, U.S. and China trade relations completely collapsing, or some other global calamity that makes us realize we have far larger problems to contend with than cheap production. Okay. Before we read articles from a market beat, let's look at articles about Carvana. Online used vehicle dealer faces mountain of financial and legal challenges. The sky is not clearing up for Carvana. On the contrary, big clouds continue to gather over the company, which was one of the big winners of the COVID-19 pandemic with a massive growth. So it was once successful company during pandemic era, but now it's the sky is not clearing up for Carvana. Since announcing its quarterly results on November 3rd, Carvana shares have lost 44% of their value and are currently trading at $8 versus $14 in a day. This translates into a decline in market capitalization of approximately $1.1 billion in 2 weeks. Has a market value of $1.43 billion. The company, founded in 2012 and based in Arizona, took advantage of favorable conditions to market its new way of buying a car. So it was founded in 2012, mm, and it went really way up during COVID-19 pandemic era, and now it's gone all the way down. Mm. The group's car vending machines stuck well with the pandemic, a period during which consumers wanted to avoid contact as much as possible. The federal government had also flooded consumers with money via stimulus programs. Interest rates were almost zero, which meant that financing the purchase of vehicle cost practically nothing. So, what problems do they face? Legal issues, and they recently fired 1,500 jobs. Because it's not only this company, but like recently, because of interest rates, right? Mm. The central bank is aggressively raising interest rates, and inflation is at its highest in 40 years. The economy is also close to recession because of this strong recession. This company is struggling. Uh, and the ways of job cuts follow one another. Used car prices remain high, but financing the transaction has become very expensive for consumers. So, because of this trend, consumers don't want to spend that much money on car. Mm. And supply chains have improved significantly, facilitating the production of new vehicles. The timing wise, they're not in good condition. Mm. So everything is mixed together, like supply chain issues um, have improved significantly, and interest rates are too high. Too high supply chain issues improve significantly, and like they have legal issues. Uh, and some people think that it's much better to buy just a new car than get used one. All this complicates the affairs of Carvana, which had to go into $3.3 billion in debt to finance the acquisition of Old Auctiona. That's its fiscal auction business this year. Enormous financial pressure. So they're having a really financial pressure. Should I keep it? Because I'm like 90% negative at this point. At this point, I don't do anything, but I'm like just holding it. Mm. Significant near-term operational and financial risk for Carvana has emerged and are likely to cloud the CVNA investment story for the foreseeable future. Oppenheimer analyst Brian Nagel said in a note on November 15, downgrading the stock. He added that we do not envision investors beating CVNA meaningfully higher until prospects for a manageable and sustained capital base become clearer. Nagel seems to confirm that Carvana has a liquidity problem, which the guru must address fairly quickly if he wants to stop the collapse. They have so much debt, right? And and Plush is not profitable. Hmm. Yeah, that's right. There's the answer here. This is especially true for fast-growing companies and for businesses that sell expensive, often financed products where the purchase decision can be easily delayed, like cars. So cars are like the ones that people hardly buy because it's expensive. They just delay it. Mm. Rather than buying cars, they would buy eateries, especially in COVID season and with interest rates like this high, right? Mm. I don't know how they would mm, get used to new environment, but they recently fired 1,500 people, and they plan to fire more because uh they're in debt and they're struggling um with finance problems. Uh, they're not so much in good condition, but because their future is not clear, their stock is going down. They even have legal issues here. Let's read this about it too. New job custom after I read too much. Let's skip on this. We all know that it's not in good condition. I'll just read more of articles from marketbeat.com, and then I'll be done with YouTube Live, okay? Hmm. What interesting articles do we have from marketbeat.com? Hmm. I don't see that much interesting articles from marketbeat.com. Okay, this is it today, and I must see you tomorrow, okay? Bye bye.